right now, your bank legally views you in, well, one of two ways. You're either a vulnerable liability that needs to be like completely bubble wrapped in mandatory protections, or you're a high-speed, sophisticated entity that basically gets to rip up the standard rule book.
Yeah, there's really no middle ground there.
And the wildest part is, you probably have absolutely no idea which set of rules you just agreed to the last time you tapped, except on your banking app.
Right. It's the ultimate illusion of modern finance, isn't it?
Oh, for sure.
We see this standardized interface, a sleek dashboard, a biometric login, and we just assume the legal machinery operating underneath is equally standardized for everyone.
Like it's the same exact contract for everyone who uses the app.
Exactly. But the reality is that private banking, specifically in a major financial hub like Luxembourg, it operates on this highly modular, almost invisible legal architecture.
And that invisible architecture is exactly what we are dismantling today on this deep dive.
Yeah.
We're looking at this really brilliant legal brief covering Luxembourg payment account terms in private banking. And our goal isn't just to translate dense legal citations for you, the listener.
Right. Nobody wants that.
Exactly. We want to reveal the underlying mechanisms. We're going to look at how the law actually defines your money, how it decides whether you get the training wheels or the high-speed lane. And this is the crazy part. Why the entire European framework is currently just scrambling to rewrite itself to deal with digital fraud.
Which is an incredibly timely issue right now.
Yeah.
I mean, the gap between what users think their banking contract says and what it actually dictates during a crisis is widening fast.
It really is. But I guess to understand that gap, we have to start at the absolute baseline.
Right.
We have to look at how the law actually defines the playing field. Because, and this blew my mind, not every account you hold at a bank is legally considered a payment account.
No, not at all. And that distinction is basically everything.
Right. I found this so fascinating. So the foundational framework here is the Luxembourg Law of 10 November 2009 on payment services. We'll just call it the 2009 baseline for our discussion today. And it completely ignores whatever flashy marketing name the bank slapped on your account.
It doesn't care if it's called the Platinum Wealth Maximizer or whatever.
Exactly. The legal litmus test, which is specifically under Article 1.5 of that law, is purely functional.
Function is everything. So the baseline definition states that a payment account is specifically an account used for executing payment transactions.
Okay, so what does that actually mean in private banking?
Well, it usually translates to your current account or your cash account. It's the hub. It's where your credit transfers, direct debits, card payments, and all your daily digital banking actually happens.
Okay, so it's defined by velocity.
Yeah, that's a good way to put it.
Like if we use a nightclub analogy, the payment account is the active dance floor. The money is moving, it's interacting, it's constantly shifting hands. But if you have, say, a securities account or a term deposit or some complex wealth storage vehicle, that's the VIP vault in the back.
Exactly. The capital is sitting there, but it's not executing direct transactions.
Wait, so if I can't pay my electric bill directly from my high-yield savings account, it legally isn't considered a payment account at all?
Not under this framework, no.
Wow, okay.
The mechanism driving that distinction is settlement risk. You see, regulators look at the flow of money entirely differently than they look at the storage of money.
Because moving money is inherently riskier.
Precisely. When capital is in motion, like when it's entering the clearing systems, moving between institutions, it requires a highly specific regulatory framework to dictate transparency, execution times, and liability.
Ah, I see.
So if your savings account doesn't allow you to directly wire funds to a third party without bouncing it through a checking account first, it simply bypasses this entire regulatory umbrella.
Okay, that makes so much sense. So let's say we are on that active dance floor. We have an account that executes daily transactions.
Right.
This brings us to the core thesis of the brief. Because once you're on the dance floor, the 2009 framework essentially takes a chainsaw to its user base and splits it right down the middle based on your status at the door.
Yep. Consumers on one side.
And non-consumers on the other.
And that split dictates your entire operational reality.
So let's break down the consumer side first.
Sure. So a consumer is defined strictly as a natural person acting outside of commercial or professional activity.
So just a regular person managing their own personal wealth.
Exactly. And if you have that status, the law enforces a mandatory rigid safety net. You get the full protective weight of the legislation, and this is key, the bank cannot ask you to waive it.
Mandatory training wheels.
Right. But then we look at the non-consumer side.
And in a financial ecosystem like Luxembourg, I mean, that side of the room is packed with heavy hitters.
Oh, absolutely.
We're talking about wealth holding companies, massive funds, family vehicles. The brief mentions SOPARFIs, which are financial holding companies, and SPFs, the family wealth management structures.
Yeah, and this is where the framework reveals its pragmatism. Because for non-consumers, the law allows massive flexibility.
How so?
Well, Articles 59 and 78 of that 2009 baseline give banks and institutional clients the power to essentially opt out of the standard protections.
Wait, they can just opt out?
Yeah, they can disapply the transparency and information requirements. They can completely rewrite the rules on charges, the burden of proof, refunds, and even the notification time limits for unauthorized transactions.
See, I really need to challenge this because to me that sounds fundamentally self-destructive.
It sounds like it, yeah.
Right. Like, why on earth would a massive family office or a sophisticated corporate fund willingly negotiate away their own legal protections?
Wow.
Why give up your right to a guaranteed refund window or transparent fee disclosures? What is the strategic upside to making yourself theoretically more vulnerable?
It's all about the trade-off between absolute safety and absolute speed.
Speed.
Yeah. Consumer protections are inherently friction-heavy. I mean, they are designed to slow things down so mistakes can be investigated.
Okay, yeah, that's true.
But a sophisticated non-consumer views that friction as an unacceptable operational risk.
Meaning they'd rather take the hit on a fraud case than, say, miss a major market movement.
In many cases, yes, absolutely. Consider a massive cross-border acquisition being executed by a Luxembourg holding company.
Okay.
If a multi-million euro clearing transaction gets flagged by a rigid consumer-level algorithm...
Oh, and it gets held up?
Exactly. It gets held in a mandatory cooling-off period while the bank conducts a standard 14-day fraud investigation. That delay could kill the entire acquisition.
Oh, wow. I didn't think about that.
Institutional players have their own internal auditors, their own multi-signature security protocols, their own risk management teams. They don't need the bank to act as their nanny.
So they're essentially telling the bank, look, we will absorb the liability for unauthorized transactions. Just process the wire the exact second we tell you to.
Precisely. The 2009 framework recognizes that a one-size-fits-all approach would choke the institutional market.
It accommodates the vulnerable individual who needs the bank to bear the liability.
And it accommodates the high-speed entity that demands a custom-built, low-friction environment.
That actually perfectly contextualizes the mechanics of how these contracts are built. Because regardless of whether you're that protected individual or that high-speed holding company, every single framework contract is built on the same structural foundation.
Right, the 3 pillars.
Exactly. It dictates how the relationship starts, how the rules can change, and how the relationship ends. So let's look at the starting line.
Pillar 1. So under Articles 70 and 71, the law mandates pre-contractual information.
Stuff like the provider details, execution times, interest rates, charges.
Right, and crucially, it requires this to be delivered on a durable medium before the client is actually bound by the contract.
A durable medium, so not just a dynamic web page that the bank can stealthily update overnight.
No, it has to be a static record, like a PDF or a physical piece of paper.
But the technical detail that really stood out to me in the brief here isn't just the fee schedule, it's the strict disclosure of cutoff times.
Oh, cutoff times are perhaps the most critical operational metric in wholesale banking.
Which is funny because for a retail consumer, a cutoff time is like barely an annoyance.
Right, you don't even notice it.
If I pay my utility bill at 6:08 p.m. and doesn't process until the next morning, nothing really changes in my life.
Yeah.
But I imagine the mechanism is vastly different when we're talking about non-consumers moving institutional capital. Why is the law so hyper-fixated on disclosing the exact minute the daily window closes?
Because missing that window by a single second can create immense uncollateralized exposure.
Just from 1 second.
Absolutely. Global finance operates on interbank settlement windows and clearinghouses like Target 2 or Euroclear. They process capital in massive daily batches.
Like the absolute final collection time at a post office.
Exactly like that. If a corporate client executes a huge currency trade and their payment order misses the bank's internal cutoff time to make that batch, the funds literally miss the train.
And what's the fallout of missing the train?
The funds just sit in operational limbo overnight.
Yikes.
And in the context of algorithmic trading or high-frequency FX swaps, an overnight delay means exposure to currency fluctuations. It means missed settlement deadlines with counterparties. It could mean potentially millions in penalty fees.
Wow. So by forcing banks to legally bind themselves to a published cutoff time on a durable medium, the law gives clients the exact parameters they need to program their own treasury operation.
Exactly. It creates certainty.
That makes the stakes incredibly clear.
Oh.
Okay, so that's the initiation of the contract. But banking relationships can last decades, right?
Oh, yeah.
And the macro environment changes constantly.
Constantly.
How does the framework handle the friction of a bank deciding to just, unilaterally change the rules?
Yeah. Well, this is the second pillar, and it's a massive point of tension.
How about?
Under Article 73 of the baseline law, if the bank wants to amend the terms, say, altering their fee structure or changing liability clauses, they are generally required to give a 2-month prior notice.
Okay.
And the user has the right to reject the change and terminate the contract free of charge before it takes effect.
I want to dig into that 2-month window because on paper, 2 months seems like plenty of time for a retail consumer to find a new checking account.
Sure.
But if I'm a corporate entity with complex treasury functions, international payroll integrations, multiple currency lines, 2 months feels like an operational nightmare.
It really is.
So is that window purely to prevent banks from holding a client's money hostage while they scramble to find a new financial institution? Is there a deeper mechanism at play?
It's an engineered buffer zone. It's designed to prevent systemic shock. You are entirely correct that migrating a corporate treasury takes much longer than 2 months.
Right, just the paperwork alone.
Yeah, the KYC Know Your Customer and anti-money laundering onboarding at a new institution can take months.
So the 2-month notice actually gives the bank a massive amount of leverage.
It does. However, this is exactly why non-consumers utilize the flexibility we discussed earlier.
Oh, right, the opt-out.
Exactly. While consumers are locked into that statutory 2-month notice, a sophisticated holding company will actively negotiate bespoke amendment clauses.
Ah, so they might demand like a 6-month notice period for any material changes.
Precisely. Because they know their own operational inertia.
They use their non-consumer status to build a longer runway. That is so smart. And that leads right into the ultimate friction point, the third pillar, termination.
Yes, Article 74. The legal mechanics of breaking up with your bank.
Right. And the power dynamic is highly regulated here too, isn't it?
Very much so. The user can generally terminate at any time, subject to a maximum agreed notice period of just 1 month.
But if the bank wants to terminate an indefinite contract, they essentially want to debank you. They must give you at least 2 months' notice.
Right. Again, we see that buffer zone. It prevents a bank from suddenly deciding your risk profile no longer fits their internal metrics and just freezing you out overnight.
Because sudden illiquidity is one of the most dangerous things that can happen to a financial entity or even an individual.
It's catastrophic. The termination framework forces the bank to internalize the risk of a client for a final 60 days, ensuring the client has a window to secure a safe landing for their capital elsewhere.
It's really a robust architectural baseline. But, the 2009 framework was built for a world that looks vastly different than today.
Very true.
I mean, the sheer volume and complexity of digital transactions just exploded over the next decade.
Which is why the architecture couldn't remain static. By the mid-2010s, it became obvious that while the baseline mechanics were sound, the transparency requirements were failing the average person.
And that triggered the next layer, right? The Luxembourg Law of 13 June 2017 on payment accounts.
Exactly.
So if the 2009 framework built the structural pillars, initiation, amendment, termination, how does the 2017 law change the game?
Well, the 2017 law is essentially an aggressive consumer protection layer, specifically targeting legibility and mobility. Okay. Chapter 2 dictates strict controls on fee information documents. Chapter 3 governs the mechanics of account switching. And Chapter 4 even mandates that banks offer payment accounts with basic features to ensure financial inclusion.
The brief notes that private banks now have to rigorously align their overarching framework contracts with all these granular realities. Their tariff sheets, their overdraft terms, their digital banking channels. It really sounds like the regulators forcing a standardized nutrition label onto bank accounts.
That nutrition label analogy is vital here because prior to this, a bank could bury the actual cost of holding an account deep in an appendix somewhere.
Oh, absolutely. They'd obfuscate wire fees, currency conversion spreads, dormant account penalties.
Right. And the 2017 law basically forces them to pull all those calories out of the fine print and present them in a highly standardized, impossible-to-miss format.
No more hidden calories.
Exactly.
But even with the 2009 pillars and the 2017 nutrition labels, the regulators aren't stopping. The brief closes by pointing to a massive new horizon.
Yes.
The European PSD3 and PSR package?
The third Payment Services Directive and the Payment Services Regulation.
So this is the regulatory watch point for the entire industry right now.
It is a fundamental modernization of the European Payment Services Framework.
I have to admit, I looked at all the protections we just outlined, the forced disclosures, the buffer zones, the strict definitions of liability, and I wonder, what is left to fix?
That's a fair question.
I mean, is the system actually broken, or are regulators just writing laws to justify their existence? Like, is digital fraud simply moving faster than our current legal definitions can handle?
It's not that the 2009 system is broken per se, it's that the technology simply bypassed it.
How so?
Well, the entire 2009 and 2017 architecture relies on a one-to-one legal relationship. It assumes you, the client, are directly interacting with the interface provided by your bank.
Okay.
But open banking completely shattered that paradigm.
Open banking meaning the APIs.
Exactly. Application programming interfaces. Think about it. Today, you likely use third-party apps to track your budget, execute trades, or initiate payments through a digital wallet.
Right.
The money and the data are moving invisibly through complex API connections. Your bank has essentially become a dumb pipe.
A dumb pipe, wow.
Yeah, and the third-party tech platform is the brain you actually interact with.
Oh, that makes total sense. I mean, I rarely log into my actual bank portal anymore. I use Apple Pay or, a third-party wealth aggregator that constantly pulls data from my checking account.
Right. So consider the liability mechanism in that scenario. If a fraudulent transaction is initiated through that third-party wealth aggregator because their API was compromised, who is legally liable to refund the consumer?
Oh.
Is it the bank holding the capital or the tech company that initiated the tokenized payment?
I see the problem.
The 2009 framework was not built to adjudicate blame in a highly fragmented, multi-party tech stack.
It's a complete diffusion of responsibility. The bank points at the app points at the bank, and the consumer is just left holding the bag.
Precisely. And that is what the PSD3 and PSR package is engineered to attack. It's designed to tighten the rules around API access, clarify exact liability chains when third-party providers are involved, and dramatically upgrade the models of user protection against sophisticated social engineering and digital fraud.
It really highlights how the law is in a constant high-stakes arms race with technology.
It really is. And it proves that a legal contract isn't a static piece of paper. It's a living protocol that has to constantly patch its own vulnerabilities.
That is perfectly said. So let's pull all these threads together for the listener.
Sure.
We started by redefining the payment account, not by its name, but by its velocity. It is the active, moving center of your financial life, which separates it from the quiet storage of a securities vault.
And then we explored the critical divide in the 2009 framework. The strict, unyielding protections granted to the consumer, contrasted with the vast high-speed flexibility afforded to the non-consumer entities.
Right, the entities who actively negotiate away their safety nets for operational fluidity.
Exactly.
We looked at the mechanisms behind the three structural pillars, how cutoff times manage settlement risk, how notice periods engineer buffer zones against systemic shock, and how termination rules prevent sudden illiquidity.
And finally, we saw how the 2017 law forced transparent legibility, while the incoming PSD3 package prepares to untangle the liability mess created by open banking APIs.
When you view it comprehensively like that, the legal text you agree to is actually a highly engineered reflection of the broader macroeconomic system.
It really is.
Which is the ultimate takeaway for you, the listener. The next time you open a financial app or authorize a new wealth management tool, realize that you are not just checking a box on boilerplate text.
No, you're not.
You are being sorted into a highly specific regulatory category. The rights you have, and the rights you might have inadvertently waived, are entirely dependent on how the law classifies your status in that exact moment.
Understanding your classification is really the only way to genuinely comprehend your financial risk.
Absolutely. Now, I want to leave you with one final thought, something that wasn't explicitly covered in the brief but feels inevitable given where PSD3 is heading.
Oh, I'm intrigued.
We talked heavily about the strict definition of a consumer being a natural person. But, we're rapidly moving toward a future defined by autonomous AI agents.
Oh, wow. Yes. That is a monumental shift in how transactions are initiated.
Right. If you authorize an AI agent to aggressively monitor your accounts, automatically move capital to optimize yield, and execute daily payments across multiple third-party platforms entirely on its own, who is the actual consumer?
That's a great question.
Is the algorithm legally acting as you, or is it a non-human proxy?
I mean, if an AI hallucinates and executes a disastrous trade or falls victim to an adversarial attack, the current legal framework for unauthorized transactions completely breaks down. Who actually provided the consent?
Exactly. Will future regulations have to legally recognize algorithmic entities holding the digital keys to our capital? It's something to think about the next time an app offers to put your finances on autopilot. The physical ceremony of the heavy pen and the paper contract is long gone. But the invisible legal machinery operating beneath your screen has never been more complex.
The architecture may be hidden, but its consequences are entirely real.
And understanding it is half the battle. Thanks for joining us on this deep dive into the hidden mechanics of private banking. Until next time, stay curious and keep questioning the fine print.